And finally, I am so pleased to introduce our moderator for the evening, Mr. Cody Willard. Cody is chairman of Scutify Apps and the editor of tradingwithcody.com. Prior to that, he was an anchor on Fox Business Network, where he co-hosted the network's longtime #1 rated show, the Fox Business Happy Hour. Cody began his career 20 years ago at Oppenheimer and has since then held roles as chief analyst for a technology venture fund, a VP of a telecommunications firm, and founding manager of his own hedge fund, CL Willard Capital. Cody also serves as an adjunct professor at Seton Hall University, teaching a revolutionomics technology and business class. Cody's ideas and economic outlooks have been featured on NBC's The Tonight Show with Jay Leno, ABC's 2020, CBS's Evening News, CNBC's Squawk Box, Jon Stewart's The Daily Show, a personal favorite, as well as in the Financial Times, the Wall Street Journal, and the New York Times. Cody, thank you so much for being here and leading our discussion tonight. Please join me in extending a warm welcome to Cody and all of our distinguished speakers. And with that, Cody, I'm so pleased to turn the program over to you. Thank you so much.
Thank you. I think we're going to jump right in with the panelists and let them present their latest thoughts on the markets, the economy, and the things that they'd like to talk about tonight. And then be sure you've got question cards in all of your programs there. And if you have any questions for any of our panelists, write them down. We'll have people collecting them, and I'll be sure to work those questions in throughout the discussion tonight. But Jeremy Siegel will be our first presenter here. And Dr. Siegel, please.
Thank you, Cody. I've been given the modest assignment to explain, analyze, and forecast the state of the world in 8 minutes or less. Okay, so we can only touch on a couple of things, and maybe we'll get to more. I'm sure we will in some questions. So I kind of took my presentation and pulled some of the more important slides out, and I'll share those with you over here. These are for the lawyers in the audience, so you don't have to pay attention to those. We have to put them in anyways, you guys understand. Deflationary forces, that's the big problem for the markets today. Of course, they're coming from oil. We have between $1 and $2 trillion of infrastructure and capital that is wrapped up in the oil industry. And in the energy industry and related industries. You know, it was nice going from 110 to 60, but going to from 60 to 26 is a whole different story. Very disruptive. 30% of capital expenditures over the last 5 years were directly or indirectly related to the energy sector. And you know, I'm in Dallas, I'm in Texas. I don't have to tell you, I mean, a lot of things are staying open on the hope that oil is going to pop back. And if it doesn't pop back, you know, the pain will be drawn out. You know, all this is perfectly fine with the Saudis. You know, by not restricting output or putting any lead there and having basically the world's largest reserves, I don't think they mind putting all the frackers and the marginal producers out. And once they get rid of those, you know, then they're going to raise the price. Now, I don't think the price ever going back to 100. With the fracking industry and all the rest, we could get a price of 60, and it could be a number of years before we actually get there. I don't think we're going to stay back down on these levels. But this is a very, very tough game. I mean, you know, if we did this 10 years ago, it would be more an unambiguous gain for the United States net. But now that we've built ourselves almost up to self-sufficiency in the energy sector, there is no question that it's very painful as the price continue to go down. Second deflationary is from China. If there's a big devaluation from China, there's where some of the risks are, because there'll be some more competitive devaluations around East Asia, because everyone wants their currencies to get advantage of the other. And that's another wave of deflation. How are central banks ever going to counteract these forces? That's the question. We don't like deflation. When you have debt, deflation is deadly. From 1929 to 1932 in the United States, the CPI, Consumer Price Index, declined 35%. Everyone with dollar debt essentially went under. And that's why central banks say we don't want it. But those of you in the commodity industry have gone down more than 35%. We've had 65, 70% declines. And you can see those with dollar debts are similarly impacted. So we don't like to see deflation. We have been able to barely prevent it on the overall level, but certainly it is a threat going forward. Let's look at the stock market a bit. Here's the price-earnings ratio on the S&P 500 over the last 60 years. And I hear so many people say about how the stock market has been in a bubble and, you know, the Fed by zero interest rates. I'm going to talk about that in just a second. That's really not the case. The median, now this is the median PE ratio over the last 60 years of the S&P 500 has been 16.8. There it is. You can bring it up. Many of you have Bloomberg screens. You can pick it up yourself on that Bloomberg screen. We're a little bit higher than that now. 17, I'm going to talk a little bit about what the PE ratio is. But we are really not very high when you consider the level of interest rates. In fact, we are really quite low when we consider the level of interest rates on a capitalization basis. When interest rates are actually less than 8%, which were way less than, the actual average PE has been 19 in the post-war period. And do you want to see a bubble? This was a bubble. In March of 2000, the price-earnings ratio of the S&P 500 was 30. Now we're at around 17. We'll talk a little bit about that in just a moment. But we are certainly not in bubble territory whatsoever. I think the word bubble is the most overused word today in finance. You know, it's only supposed to apply to a major asset class that is in major misalignment with its fundamentals. Let me show you a bubble. NASDAQ in 2000. Wow. Price earnings ratio of 600 at that point. That is a true bubble. We throw that term around way too much now. It's good to keep it in. And we're really selling a little over half what we sold in March of 2000 for the S&P 500. All right, let's take a look at where do we stand with the market, because I know many of you are interested in the stocks. Yeah, we're going to have earnings down around 8%. That's all due to the energy sector, which is going to actually have a loss this year, a rather big loss. Excluding energy, actually, we're up 7% in earnings last year. Actually, if you exclude energy and materials, which is a related sector, we're actually up more than 8%. Now, one can argue whether, you know, energy is oversold or undersold. All right? But I've written a lot of articles about it's wrong taking the losses of one sector and using them to evaluate the price-earnings ratio of the entire index. When you have a lot of losses, you should take those out. If we take out just the energy sector, the S&P is selling for around 16 times last year's operating earnings. 16 times last year's operating earnings. That's actually less than the median ratio. Now, if you take a look at reported earnings, it's selling for around 18 times earnings. Well, what does that mean? If the PE is an 18 times earnings, there's a lot of literature, and I've written some of it, that the best way to forecast what real returns are going to be in the stock market is to flip the price-earnings ratio, take what's called the earnings yield. That's a forecast of real returns. 1 over 18 is 5.6%. And I'm actually forecasting real returns next 3 to 5 years at 5 to 5.5% on the stock market from current levels. Now, that's not as large as the long-term average, down about a point, point and a half. But that reduction, as I'm going to show, is much less than the reduction that we've seen in the fixed income market. By the way, real PE of 5.5 is a 7 to 7.5 nominal rate of return. That's about 5% over the bond. Actually, it's more than 5%. The bond has dropped to 10-year dropped to 1.7. The difference between stock and bond yields is what we call the equity risk premium. Historically, it's been 3 to 3.5. Now it's 5 to 5.5%. So yes, stock yields are going to be down, but bond yields are going to be down twice as much as stock yields. And the margin of stocks over bonds, using from today's level with objective criteria on earnings and on interest rates, is clearly above its historical level. You know, what are the determinants of real interest rate? One of the biggest myths on Wall Street is that it is the Fed and the central banks that have forced interest rates down to zero. Well, one of my topics that I studied in detail at MIT, pure theory of interest rates, that was my specialty, monetary theory and policy theory of interest rates. And basically, real interest rates are impacted by two factors, real growth and risk aversion. Nominal interest rates, in addition, then, of course, are impacted by the rate of inflation, or in our case, non-inflation or deflation. Those three factors have driven the interest rate down to zero. You know, we used to have average GDP growth from 1962 to the financial crisis was nearly 3.5% a year. That's what the TIPS was yielding when it was first floated in January of 1997. But we're going to have much slower growth in the future. CBO projects 1.5 to 2% real growth in the future. That drives real yields down by at least 150 to 200 basis points, and we have a huge amount of risk aversion. Aging investors, we have a tremendous increase in the desire for liquidity. We have the de-risking of pension funds, which is huge. Defined benefit pension funds getting rid of their stocks in favor of bonds for a number of reasons. That's hundreds of billions of dollars going into the bond market and the safe bond market, what we have right now. That is what's driving interest rates to zero. I think we're going to eventually get the 10-year TIPS at 1 to 1.5. And with the term structure effect, that means short-term real rates are going to be zero. Okay, and that means that, you know, you all know about the dot plot for the Fed. It ain't going to 3.5%, as they say. Really, 2% is going to be probably their limit. I'm going to talk about the Fed in just a moment, getting through a couple of other slides. By the way, where are people going to go for income? Because interest rates are going to stay really low for a real long time. I mean, a decade or maybe longer. And here, I think, is where stocks are definitely going to shine. Here are the dividends from the S&P 500, an index that was actually first formed in March of 1957, comparing it with the Consumer Price Index. In both high inflation and low inflation periods, dividends have outpaced the rate of inflation. And we have had enormous growth. The decline in dividends from 07 to 09 was completely the financial sector. Actually, surprisingly, the dividends in the other 9 sectors taken together were higher at the bottom of the bear market than they were at the top of the bull market before we had the big financial crisis. Dividends have been increasing at a rate of over 12% a year for the last 5 years. And even last year, where earnings were down 8%, there was a 10% increase in dividends. And the firms have a tremendous margin that they can continue to increase dividends at. Of course, firms have substituted buybacks for dividends because of the taxation on dividends. We have a dividend yield right now, the S&P 500, of 2.3%. The 10-year is 1.7. You don't find many times in history where the dividend yield on the S&P is above the 10-year. In fact, there was a 60-year period between the 50s and early 2000s where it was never true. Now it is true, and firms have the capacity to raise those dividends dramatically. I mean, buybacks are 2 to 3% a year. If they change some of those buybacks, and if you add buybacks to dividends, and they can change the buybacks to dividends, and if we had some favorable tax laws, instead of raising that dividend tax from 15 all the way to 23.6%, as Obama did, 50% raise in the dividend tax, if we have some favorable tax laws over there, we could easily have a 5% dividend yield on the S&P 500, just from taking the buybacks, which is cash that they need, and turning them into dividends. That is a rare opportunity going forward. Now, one last topic I want to talk about, which is a really important macro topic. It's a longer-term topic, something we have to think about. Productivity, shocking collapse of productivity. Over the last 60 years, since 1947, the average productivity growth on the S&P 500, productivity growth of GDP, not the market here, productivity growth in the economy, which is defined as GDP per hour worked, has gone up at 2.2% per year. This is the foundation of improvement in our standard of living. It's why every 30 to 35 years the standard of living doubles, and has for not only the last half century, but data we got back all the way into the 19th century. We've had about a 2% per year increase in productivity. It has averaged, well, with the latest data, which I don't have in there because it just came out a few days ago, 0.4% over the last 5 years. Let me just give you one thing that just shockingly illustrates this point. Fourth quarter last year, all right, we had a great labor market. We had almost 1 million net hires in the labor market, all right? Do you remember what GDP was, growth in the fourth quarter? It was first announced at 0.7%, but now we've gotten more data. Some of the latest forecasters say it's 0.2%. Basically, zero increase. That was, and the productivity came out 3 days ago, minus 3%. Minus 3% for the fourth quarter. By the way, when you have falling energy prices, you're supposed to boost productivity above its average. When you're in recovery from a recession like last 5 years, we should have boosted recovery. Actually, if you do the regressions on history, we should have had 3 to 3.5% productivity growth. We don't understand why it has collapsed so thoroughly. This is actually unprecedented in the post-war period. I mean, let me give you a couple of reasons. I've been told that in the financial community, since 2009, the only net increase in workers has been in the compliance department. Now, I'm not going to say anything of whether I think that's good or bad. They don't produce any more measurable output of the firm. We got lots of regulations and regulators that are not producing any output in the firm. Is this one of the problems that we're had in terms of productivity? Secondly, and this is part to do with deflation, we're not getting increases in revenues and wage pools to incentivize the better workers. You know, when inflation is 2 or 3%, we can always keep the less, productive workers even in terms of salary. You can't lower them, though. That's it. You learn institutionally, don't cut it. I mean, if you don't raise me as inflation, I'm not happy, but, it can be done. But when you don't have any inflation, you got to keep everyone on. It's hard. You don't have a wage pool with profits to start incentivizing it. Now, I know many of you work on a commission-type basis. You're not impacted by that. But there are millions that are in that situation. Finally, this is the last comment I'll make over here. The question, are we really measuring GDP correct? Maybe we're understating GDP. Maybe our digital economy is producing so many free goods that we don't remember. Remember what GDP is. Price times quantity. If price is 0, it disappears from GDP. Do people remember the point-and-shoot camera? That was a $4 billion industry. No one buys those anymore because they get it off of their phone. No one buys GPS standalones anymore because they get it off their phone. No one buys reference books. No one buys encyclopedias. atlases, dictionaries, thesauruses. That was a $45 billion industry. They all get it off of Google, off their phones. We can go on and on. Maybe there is a lot of stuff that we have. We're just not getting it into GDP. But you know what is interesting about that? And these are sort of my closing words. What that means is that prices are actually going down faster than we're measuring it. They're not measuring these zero prices in our system, which means that deflation is actually more of a problem than even the official statistics show. So these are the challenges. I think stocks, in summary, are extraordinarily reasonable from today's level. We're in a lower return world going forward, but much more lower for fixed income than we are for equities. And that the margin of stocks over bonds is still going to be a very, very healthy margin by any historical measure. Well, thank you very much. Here.
That's a great start to why we're all here tonight. I hope you are pondering some questions and perhaps making some notes. I know I did. I can't wait to get the panel discussion started. Let's move on to Bill Eigen, please.
Thanks, Cody. Thanks, everyone. It's good to be here in Dallas. I like the people down here, I like the politics down here, and I like the taxes down here. Being from Boston, pretty easy to see why. I really enjoyed that last presentation. I like listening to angry bulls. It's because I'm one of those too, except in a different area. Being a fixed income manager, I agree with everything the professor said about, it's almost an impossible return world in traditional fixed income, because once interest rates get to zero, unless you're in Europe, for instance, where they engage in fixed loss investing, where you lock your losses up in advance, buying, like, for instance, 10-year German boons at minus 40 basis points, on the blind hope that the greater fool theory prevails, you'll be able to unload those to someone dumb enough to buy them at an even more negative yield. But that's not the way the world should work. That's the world we're in right now. Now, that being said, there are some subsets of fixed income that are just incredibly valued right now. And that's what I want to talk about during the course of my presentation, because this is an environment I've been waiting for since 2009 and never thought I'd see again, but I'm seeing it. This is a market driven by emotion. It's a market driven by fear. It's a market that's driven by irrationality in the case of many forms of lower rated credit, especially, and also all forms of credit attached to it, everything from fixed income closed-end funds targeting high yield and loans, for instance, all the way through to things like business development companies, preferreds, et cetera. And that's why it's a great time for me to be up here talking, because if you were to have me speak at this thing in 2014, you would have been incredibly bored, right? My fund at that time was sitting on 70% in cash. I just hated everything. There was nothing to do, because margins of safety available in the market were almost nil. High yield, for instance, at that time was trading at like 300 basis points over treasuries, which is ridiculous, ridiculously tight. And what were people doing? They were piling into it. Okay, they were buying high yield like it was going out of style. Now you've got spreads between 900 and 1,000 over, where they've only been 3 times before in history. And all 3 of those times we were not only in a horrible recession, but the default rate was spiking. Okay, we're right back there again. This is the first time we've ever been there with actually the economy, not in depression type mode, but actually growing a little bit, albeit not that much. And yet here we are. And a lot of this is liquidity driven. A lot of this is fear driven. A lot of this is people just exiting the asset class, and the dynamics of the liquidity of the market have changed a lot. Okay, market making activities are not as profitable as they used to be, and they're overregulated now. No one wants to engage in them. So when you go to sell your high yield bonds in a panic, the JP Morgans and the Goldmans aren't going to be there for you to put them in inventory. It's going to be guys like me downbidding you 5 to 10 points, okay, to put those bonds into our funds. All right, and that's how liquidity has changed, and that's why the volatility is so exacerbated to the downside in a market like this. Just like this market will go offerless when people realize they do need income again, okay? And when you look at what's happening in the market, and you look at I only have 2 slides, by the way, so I'll only spend, I guess I can spend 4 minutes on each one. you look at what's happening in high yield here, and by the way, this slide is way outdated because it's as of the end of January, okay? The market's completely fallen apart even more in the first 10 days of February. So currently, when you look at your par-weighted price in the high yield market using the Merrill Lynch index, which is fairly conservative relative to some of the other ones, it's down to about an 81 level. Okay, so you're almost down to $80 par-weighted price in the high yield market, which has only been pierced a couple times before in history. In '08, you got down to the high 60s, but this is not 2008. You don't have enough leverage in the system to accommodate a 2008 again in this market. So your spread to worst actually in this market is like I said, over 900 basis points now. Now, looking at the implied defaults, which I don't love to do, but it's interesting. It's an interesting mathematical exercise to look at what is that spread implying about defaults in the future in the high yield market? Like how much are you getting compensated for defaults? And if you look at where spreads are today and look at the implied defaults when you back out what we call the excess spread, which incorporates both a risk-free rate plus historical default loss and a liquidity premium, you're at about 10% now. Okay, so you're implying about 10% defaults in the high yield market when actual defaults right now are around 2.2, 2.3. I expect them to go higher, maybe 4 to 5. Everyone in here is like, well, what about energy? What about energy? Energy is only about 10% of the high yield index, okay, and going down every day. Because you know what the average dollar price of the energy component of the high yield index is? Well, today it pierced 50, okay? You're at about $49, okay? So you're at less than half of par value. Now, what is that implying? Well, essentially what that implies is that half of all the energy companies in the high yield index, including the refiners and others that aren't that sensitive to oil prices, are going to go away at zero recovery. Okay, or alternatively, you could say 2/3 of the market's going to go away at a record low recovery of 20 to 25 cents on the dollar. Because remember, we're talking about the top of the capital structure. No offense, but we're not talking about equities, which are the bottom. Equities what's left over after I get paid. Right? So, again, this is getting excessive. And yet no one cares. No one talks about this. And that's why I almost felt like I needed to apologize in advance before I came up here for sounding at all optimistic about anything, right? Because I know that doesn't get press right now. What gets press is telling you oil's going to go negative. Right? I actually read an article on that last week. And I had to send it to Jamie Dimon because I was so fascinated by it. It was written by a same person who, in 2013, had a website dedicated to peak oil. Saying, and I'm not kidding, this is absolutely true. It was the same author. He had a website dedicated to peak oil in 2013 saying it was going to $300 a barrel, and now he's saying that oil prices are going to go negative. I said, well, that's fascinating. So I'll get to pull up to the gas station, put in my debit card, and it'll have a higher balance on it when I pull out of the gas station. So I'm very much looking forward to that when that happens. This market is in what we call extreme contango right now, where if you do own a tanker, it will pay you quite a bit to fill it up with oil and just anchor it offshore for a little while, a few months. But what I'm trying to get to here is that these are really good opportunities right now. And they don't come along every day. And yet most people are running from this asset class and exacerbating the downtrend as opposed to looking at it rationally and saying, what am I getting paid to be in this asset class? What's my break-even period? What does the math dictate here? And even if you can imply defaults of 10 to 12%. Think about what that means for other areas. If the high yield market's right, and we are going to see 10 to 12% defaults, what do you think that means for the rest of your portfolio? Seeing that we're at about 2.5% now. What do you think happens to equities in that scenario? So the question is high yield overshooting, which it almost always does, historically always has, and historically has always been the worst bought and sold asset class by investors on the face of the planet. When do investors buy high yield and pile into it? When the returns are high. When the returns are high in high yield, what's it mean? The spreads are very low. When spreads are very low, what's that mean? You're not getting compensated to be in the asset class and you're going to lose money. Okay? When do they sell it? Now. People are clearing out of it like you wouldn't believe. It's the ultimate PIPO asset class. Panic in, panic out. Okay? And it happens every single time. And I have to smile when I say this because I really enjoy it. Because it causes pricing to get so crazy in some areas. Why are the same Sprint bonds, Sprint, which a company has fine EBITDA trends, has a very large financial partner, the metrics are all fine. Yeah, they've been downgraded once or twice, big deal. Why did the bonds go from 105 to 58? Right? Is it that bad? Are they really on the staring into the abyss right now? No, of course not. Why is everything getting thrown out now? It's not just energy. People seem to think it's just energy. It's not. It's consumer names, it's retail, it's everything. Even when you exclude energy, the high yield market has just absolutely gotten throttled. And yet the fundamentals, whether you look at debt coverage, EBITDA coverage, net leverage, they're all fine. They're not even approaching levels that we saw in previous bubble periods like '07. I do agree the word bubble's completely overused, especially as it relates to certain forms of fixed income. So this is a really, really good time to look at this asset class. And another reason why, when you consider it, there's so many interesting things going on around it. Look at this chart. Absolute extreme. By the way, extremely outdated. Again, because it's as of the end of January. You run this through yesterday, this multiple, the relative value of high yield, I like to call it, is at about 12. Okay? 12. Now, what this is saying is that when you look at the yield to worst on the relatively conservative Merrill Lynch High Yield Index and compare it to a portfolio of global government bonds with a duration of 7, which is the Merrill Global Government Bond Index, which has a yield of what? 79 basis points. Yes, that's what you get paid for taking on 7 years of duration. Congratulations. So basically what that means is if rates go up 1% from here to where they were, what, just a few months ago, you're going to lose a nice 7% chunk. But of course, we all know rates never rise. So I shouldn't even bring that up. But again, 12, that's your multiple, 12 to 1. What are income-oriented investors to do? Here they have the highest amount of income that they've had available to them in the form of yield staring them in the face, and they're running from the asset class at this extreme level and running to the area that's the denominator of this equation, which is that global government bond yield of 79 basis points. That's where the flows are going. You people know that, right? Like all the outflows from high yield, which are at record levels right now, are going into core type bond funds with durations of 5 to 7 years that target government bonds, investment grade, et cetera, areas of the market that I have absolutely no use for at these levels. So again, there are so many different things going on in this market and so many interesting things going on in this market. And it's not just limited to high yield cash bonds. You look at synthetics, you look at credit default swaps, credit default swap oriented indices, including total return swaps targeting high yield, even including the ETFs that target high yield, which by the way have been a huge source of volatility for this market. My problem with ETFs, I don't have a problem with all ETFs. I have a problem with ETFs that target the least liquid areas of the market. And can you imagine why? Like when you look at high yield and loan oriented ETFs, okay, you're granting a free option to investors that does not exist. You're allowing them to trade asset classes that take up to 20 days just to settle the trades, and you allow them to trade them by the second, right? That option it's not a real option, and it exacerbates volatility both ways in these markets. But trust me, to the extent that markets in this area are bidless right now because of the massive outflows and the massive selling, which is completely dislocating pricing, they will also go offerless when this turns. Liquidity works two ways, okay? And I'll conclude to some extent with this. If you're talking to managers, I don't care whether they run a hedge fund, which I did for years, I don't care whether they run mutual funds, and they're poo-pooing this asset class, high yield, and they're not looking at it here or adding around the fringes or at least chipping away at it here like I'm doing, they're never going to buy it, right? Because their emotions have completely taken over that decision. They're so angry about the losses it's created for them if they owned it or they just hate it all the time that they won't be able to get over that emotional hump and actually buy it. Because if they're not buying it here when it's close to record spread levels, and by the way, a 3-year return in high yield that's negative right now, okay, which has only happened once before, okay, and each time, the last time it happened was followed by about a 50% return, okay? The last time spreads crossed 900 over, every single time in history, high yield bond spreads have crossed 900 over, 12 months later, you've got a double-digit return in every single case, 40 years of history, okay? But people are too busy cowering in the corner with their blankie and sucking their thumbs, terrified of everything that's going on in this market and actually selling that relationship, doing the opposite, as opposed to doing what should be done, and that is starting to chip away at this asset class as it shows extreme potential for outsized returns. One thing I'll say, this is full contact investing right now. I mean, you got to get in there and fight. It's hard because if you're not a free thinker, if you're not willing to do the math, to look at the break evens and come up with a rational argument as to why you're doing this, you're probably never going to do it. But the math doesn't lie. The spread levels don't lie. The average dollar price doesn't lie. This relationship doesn't lie. Everyone in this room knows, okay? It's a great time to be chipping away at this asset class. I'm not telling you to go all in. I'm saying just start to chip away here. You're never going to get the timing perfect. But once you get over 800 to 900 over and an average dollar price down as low as it is, that's when you want to do it. So look at some of the areas that target high yield. Look at high yield cash bonds in areas, not just energy, but outside of energy, because they're all getting killed right now. Look at the business development companies, okay? There's a number of these, and if you get me offline and give me enough beers, I might sneak a few names in. There's some of these things that are trading at 50% of book value with 19 to 20% yields that are targeting all first and second lien loans with very little leverage. They've just been crushed. NAVs lower than they were in 2008 in the throes of the financial crisis. Same with the closed-end funds. You've got unlevered closed-end funds targeting high yield and loans that are trading at 15 to 20% discounts to NAV, right? That have NAVs down close to '08 levels. That's panic, folks. And you want to take advantage of panic. And that's exactly what we're doing right now. I don't even need to talk about the fund because I'm doing just as much in my personal account as I'm doing in the fund, right? Because I eat my own cooking. Again, I never thought I'd see this again after 2008, and yet we're seeing it. So again, I would advise you to look at that opportunity set very carefully. Look at what works for you. The math doesn't lie. And again, I think it gets a little worse before it gets better. But I think considering some of these things to do right now, I think 12 to 24 months from now, boy, will you be happy you did them. Thank you for your time.
Thank you.
Thanks.
2 for 2 on the bulls. Will we go for 3 for 3? Michelle Seitz.
I am just very glad I don't have the word bubble anywhere in this presentation. and I'm sweating bullets. I don't think anyone other than Jennifer is here, and she won't tell on me, but I'm also glad to see that Bill forgot to show his presentation to compliance. So I don't have any of the disclosures either. I thought about that. But anyway, unfortunately, we would agree. So you're going to hear us say the same thing. But I'm going to take a slightly different tack. First, I just wanted to make sure that I talked a little bit about my perspective. We're a long only predominantly. We do have alternatives as well in global macro, but we have been fundamental investors, very long-term oriented, and then focused on the most sophisticated, many of them in the room, investors that truly value what we do. And so from that perspective, just thinking about an institutional client base, a very active high net worth client base, and sub-advisory and public funds, just that's the backdrop of my perspective and conversation. It goes broader, but just so you know what it is. The first thing I would say is that one of our managers talks a lot about tides, waves, and ripples. The main point is the gravitational pull of the markets is relative value. We think the tide is completely rising. Unfortunately, we're going to have all three bulls here at the table. But I would say that emotions are very high. So I'm going to take a slightly different tack since I have 15 years of the industry leading an asset management firm. I'm going to put the lens on our industry as much as I do about our clients and a little bit about the markets because I knew these two gentlemen would cover that sufficiently. Certainly the waves are pretty darn large. I was asking our managers, so are these typhoons? You know, tectonic shifts of '08? And they really are just large waves and largely driven at this point by emotion, and the ripples are everything that we're inundated with. I mean, the fact that we're all reading the newspaper before we walk out the door just because we might miss a 40% decline in LinkedIn or whatever it might be is truly absurd, especially when you don't have the structural issues that we did back in '08. So I'm going to talk about three main areas: clients, our environment. I'll do our environment briefly because you had a great overview. And then our future, which is I'm talking about the future of the industry. So the first on our clients, the answer is our clients need us more than ever, and they have problems. We have a looming retirement crisis. A lot of people have talked about this. Jeremy referenced it a little bit when he talked about the DB plans de-risking, but this is an enormous wave, a tide. that makes up our industry. So we largely exist, this 70 or so trillion dollars, 90% of it is for the developed markets for retirement needs. So just remember, that's what we're here for, developed markets, retirement needs. Jeremy also has done lots of presentations in the past about demographics, the future that's already happened. They're all getting older. So we know that, the baby boomers, but it's an enormous tide that's occurring within our industry, and it's going to change life for all of us as we know it, and it's going to dramatically change how we do business as we go into the future. Second key thing is pretty obvious, but as they get older, they're going to stop saving and they're going to start spending. That's our industry. The next one is that State Street did some great work, Suzanne Duncan, if anyone knows her, but she did an enormous survey. These are US investors just saying, are you prepared? Do you have savings? Half of the group have very little to no savings. The other half have a little bit outside of their DB plans, but they haven't saved enough. You all know that. And the other question for global investors is, do you think you're prepared for retirement? 12% thinks they're prepared. Pretty big numbers. Low real returns, we're not going to make up the difference as hard as we all try. We're not going to make up that difference, especially as they start de-risking their portfolios, as they likely should. And the longevity risk, the fact that we're all living longer, is shifting to the individual at warp speed. Corporations are trying to get these DB plans. Most of them are frozen now. You're all managing a lot of those assets. They're de-risking, moving into DC plans, IRA rollovers. But individuals are the ones that are going to have to figure out this problem and this lack of funding. Nearly 2/3 of investors, unfortunately, think that they're ready to do this. They believe that they're sophisticated and they're prepared. When they actually took a test, and this was a very large survey, they failed even the most basic level of financial literacy. So they're very ill prepared to take on this challenge. Trust is eroding at the same time. Flash crashes don't help. They don't know what the world we're all doing. It seems like the game is rigged. You've got movies about us. I actually did like the movie a lot, but it doesn't put us in the best light. And this is a great, Cornerstone came out with this a couple of days ago, but it's a chart. The chart is showing the number of news stories about structural issues in the industry and the economy. And so you see the wall of worry. I mean, all people hear is that, number one, they're running out of money. Number two, they need to retire. Number three, they've got real interest rates. They're incredibly low. And number four, they can't trust the system. So it's a very difficult thing that we're up against. In terms, what does that say? Large and growing income inequality. Our income inequality in the U.S. is, I think, the numbers are as high as they are in China. The growing populism that we're seeing, I put that up there before they won New Hampshire, is truly a bit disconcerting. And then global equity market corrections, you know, it's fine if they don't quite trust us and they think the game is rigged and there's a little flash crash, but when it comes back, they all feel more comfortable. I am worried that at exactly the time that they should be buying into these markets, they will be selling out of them because they can't afford to lose the money and they don't trust that they understand the system. The next one is our environment. We talked about structural changes. I will touch on, Ian Bremmer did a great book. He's president and founder of Eurasia, about the G0, the concept that every nation is for itself, the end of capitalism. But effectively, it's saying that there's no global power or group of regions setting the international agenda, that you effectively have a G0. And we are seeing that with very high geopolitical risk. We take advantage of that in our global macro strategies. But that does insert another element that does divert attention from relative value and the fundamentals at a company level or a market level when you do have that level of risk, whether it's in China or it's in Brazil. The rising influence of emerging markets, we see that they just have different agendas. Authoritative regimes don't have exactly the same agendas that we do. We can talk about that a little bit more. And Bill talked about this in terms of the rise of ETFs and factor investing. They do get to be crowded trades. When you do see these things, you see the illiquidity, you see the disconnect between the daily trading and the underlying illiquidity of the assets. There aren't a lot of them. I think there's a lot of benefit to both efficient beta as well as ETFs, but they are a new element which fundamental investors are trying to work through with their portfolios. In terms of heightened regulatory environment, it's extreme. I do sit on a board that's at least gives me a purview into some of our governmental institutions, and they're stepping in to try to help the investor, and they're creating lots of dislocations in the process. Bill talked about this too. In some instances, we certainly see stocks, markets, where 40% of the volume is not true liquidity. So I'm not talking about liquidity as we didn't have liquidity back in 2008, talking about the fact that we have volume prints that aren't real. They're trading algos, they're very fast. I mean, investment banks are no longer in the business of being an agent for a trade. They're in the business to make a commission, and the other side of the trade are all the trading firms in Chicago. And they're not there to provide liquidity for you. They're not there to find another side of the trade. And so that does have enormous disconnects when we're trying to find markets, make markets in certain areas. The last few points is there is an overwhelming sense that markets are being manipulated. What's real anymore? Whether it's government intervention, it's currency controls, a lot of this surrounds China. But the last one, too, is just the global central bank intervention. Jeremy touched on it. I'd love to hear more. But what we see and hear more consistently is just what is the real growth of global GDP if you no longer have central banks coming in. And so at the end of the day, we too believe that the voting machine is enormously negative, but the weight of the evidence is that this is certainly a rising tide. We certainly see value in the markets. Emotion could overshoot it, but we're actually quite interested in the valuation levels as they're panning out. In terms of our future, the industry, our industry, just based on our clients, the industry is maturing. So we'll no longer have real growth in the industry. If we do, it'll be low to mid-single digits. Effectively, it's a takeaway game. We're going to be competing with each other on market share, ETFs, passive investing, all great introductions, frankly, into the system. And for the clients, I think that they're very additive. We're fully active management, but the answer is you've got that scenario, and you also have us competing against each other for increasingly commoditized products. And so from that standpoint, you do need to make sure, all of us need to make sure as an industry, we need to make sure that our value propositions are incredibly clear to the client, and that we really are we've focused historically on serving, think about it, very few, big sub-advisors, the FA industry, the wirehouse industry, the high net worth industry is a little bit more fragmented, but the institutional money management industries serves very few clients. We're going to have to be cycling to serve very many. That's a very big business model change. I think very few institutional managers will handle that deftly, but that is a transformational business model change. The next one is, I said this long ago, the reason I'm here actually is my first boss asked me to come here. And I remembered, I started in 1987, and I didn't quite realize that was a flash crash because of portfolio insurance. It felt really serious to me. But when I was at Nations Bank, we used to talk about it's all about relative performance. And my answer to that is it's relative until it's negative. So I really do believe people are talking about products to outcomes, solution-oriented, absolute return focus. I think at the end of the day, we will always be held accountable to some standard. I don't think benchmarks completely go away, but I do think the standards will be very high. I think they will be both relative as well as absolute, and that will be a very difficult thing for all of us to maneuver. In terms of innovation, I do think that innovation will be the new normal. I think it's true of product development, vehicle development. We've been vehicle agnostic for a long time, but that puts margin pressure on us as a business, and also in the delivery to the end clients. In terms of the industry and finding a higher ground, I would say clients ask me, what do you lose sleep about? And I think they're going to think I'm talking about teams, and I do talk about people. My sense of urgency is that clients are underfunded. The clients' needs aren't being met, and that has a sea change for all of us. It's an enormous opportunity, but it is the biggest sense of urgency that I've felt in the last 30 years of the business, and we've had lots of machinations. But I think just as a foundational point, the industry is changing very quickly, and it's not going to change back unless real returns are quite high, and then we might get another reprieve. In terms of fight short-termism, so Larry Fink and Jamie, I think, have written many public letters recently trying to convince CEOs to focus on long-term investing in their business and making sure that we don't err on the side of doing short-term buybacks and things like that. I would just say that I think we all contribute to the short-termism. I mean, clients do it to us. We blame the clients. CEOs blame the shareholders. The CEOs blame the corporate boards, incentive packages. I mean, the answer is this is a cycle. And we all get held accountable to shorter and shorter time periods of measurement. And then incentives get built around that. I don't know what breaks that cycle, but it is a very dangerous long-term effect on society and also on client portfolios. So I'm very happy to see so many high-profile people talking about it, but I think it'll be a hard one to break because it's so endemic in our industry. And then lastly, I would just talk about technology. We've been one of the last areas to embrace technology in terms of industries. I think fintech, Silicon Valley has stayed away from us for the most part because of the heavily regulated nature of our business. But you can see it happening very fast. Blockchain will be a very disruptive technology to the plumbing of our entire system. But I think that's an enormous opportunity for us to think about. And then finally, I don't know, did anybody see this? It was several years ago, but I vividly remember it all the time. It was like a sheep avalanche in Turkey back in 2005, and it does remind me about many of the things we do in the industry, like our 9 boxes and slicing and dicing everything into the smallest categories and rolling out 1,000 products that we all compete against each other on. But in Turkey, 450 sheep, the leader jumped over a cliff, and literally every single one followed. 1,500 of them actually jumped over the cliff, but the 450 that died provided a cushion, so the other ones didn't die. But it's a very stark visual when you're thinking.
Nice analogy.
Exactly, isn't it? But when you're thinking about the emotion that takes over, and all of us are susceptible to it, I think the reason we become good investors over time is because we can compartmentalize that emotion. You've seen it several times. You can remove it. You can be excited about it, as Bill was talking about. But I do think at the core, major innovations and disruptions usually bring transformational business practices. We've seen a few, PowerShares, Wisdom Tree. We have seen a few things start to disrupt on the margin our business, but we have not seen transformational business practices in our industry, and I do believe it's coming. I think that net effect will have much better outcomes for the client. It's a very exciting time, and I think it'll provide us with many opportunities. So I'm looking forward to it, but we're net positive as well. Thank you.
So can someone give me a sense of timing here? How long do we have for questions and answers? 40 or 20? 20, all right. Quick question for all of you out there. Since we had 3 for 3 bulls, how about the audience? If you're bullish, raise your hand, and if you're bearish, don't. You guys were all embarrassed to say you were bullish already, huh? How about your clients? How many people have scared clients? Not a majority. If any of you do have questions, please write them down on the card. I'll be sure to work them in here in the next 20 minutes. So panelists, if you can, keep your answers as brief and succinct as possible. I've got a question for each of you, but I'm going to start off actually with Eigen's charts and looking at the record spread that you threw out there. You mentioned the denominator.
Yeah.
So if we go to negative interest rates, what happens to your spreads? We go infinite.
Yeah, exactly. Well, that's what's crazy about this environment is the things, fixed income just doesn't follow the same rules it used to. There used to be a margin of safety associated with owning fixed income, right?
Well, the margin of safety, for example, like you said, with the German bonds would be you're committing,
right.
I know I'm getting 99
yeah, I'm
cents
going to lose
back
this
in
much. I'm going to set my loss
7
in
years.
advance, and that's why I said it's become fixed loss investing. So take every textbook you ever had in post-grad and throw it out, right? Because none of it applies anymore.
So, Dr. Siegel, how do we break the cycle of this race to negative interest rates across the developed economies and the currencies that we're all trying to use to make our money?
We used to teach, and all our students, real rates could turn negative, and we discussed that,
Yeah.
but nominal rates will never turn.
It was a standing rule.
And so I used to stand up in front of the class and say, who would ever, loan somebody $1,000 to get $990 back when you can take the $1,000 and put it in your pocket and get $1,000 back?
So,
So,
but that
I mean,
underscores-
it was like, and everyone nodded their head and
And
said,
look where
who
we
would
are.
ever do that? All right, so, there's a couple of things that have to be said about this. First of all, with $1,000 for an individual that has access to the currency, that's true. When you talk about $1 million, whoa, you need a lot of safe deposit boxes, and you better make sure the tax authorities aren't looking at you too, and the compliance people, and all the rest. So when you got a lot of money, hey, maybe you'll accept a little negative interest rates. How else are you going to bring it forward as far as that's concerned? Also, when you go to other countries, you don't have access to the bank. And the biggest negative is Switzerland, because people just don't have access to Swiss banknotes. If there was free access to Swiss banknotes, it wouldn't be negative. I'll just take the Swiss banknotes.
And that underscores
people have to know someone in Switzerland to get the banknotes and all the rest. So they say, I want to own the Swiss franc. Yeah, I'll suffer a 1% loss because I think its currency is going up 5% against the euro and the dollar. Now, for anyone in the country, it's insane because he or she can just take the banknotes and put it in their pocket and guarantee themselves zero. So,
Very attractive rate of return.
yeah,
I think what I'm trying to get to is there's a structural system that is forcing rates and forcing savers into asset classes that they don't necessarily find in their best interest. That's a busted system. Michelle, how do we fix that system, and what does it mean for our bullish stance up here?
Yeah, it's interesting. In The Economist, there was an article about this too, that at some point, there will be other avenues. I mean, there is a limit to how much you can actually put in your mattress. There's a limit to how much you can sit around and hoard cash. But maybe there would be securitization kinds of firms that would pop up and make the payments of monies back and forth without it going through the banking system. But there is a limit to negative real rates, and I think Bank of Japan clearly doesn't think there is. They were touting the fact that they could continue to do this, but I think also the fact that it's not working. I mean, it doesn't truly drive.
It doesn't stimulate your economy.
No, it doesn't truly. It
stimulate
hasn't
Why
worked
do we
for-
want the
yeah.
Federal Reserve to be active at all? You mentioned earlier G20 going to G7 to G0 not being capitalism. In my mind, that is capitalism. G20 is socialism, fascism, communism, whatever you want to call it. That's central organization. Capitalism has no central controls.
Well,
Right.
one should also point out, I mean, the Fed, it's crazy. The Fed has the highest interest rate on reserves, not only in the world today, but in the world ever. They're paying 50 basis points on $3 trillion worth of bank reserves. There's no place in the world has ever paid that amount. I mean, it's really an amazing number.
Is that capitalism?
Well, it's So they used to pay, the first 99 years of the Fed, it was mandated 0. Then they could pay interest, they paid 25. And then they decided they're going to raise the interest on reserves every time they raise the target of the Fed funds rate. Now, there's actually a good reason why they have to do that, because that's the way they immobilize $3 trillion of excess reserves. Because if they started raising their target above the rate they paid on the reserves, all that money is going to go out in the economy and be very inflationary. So in a way, they're sort of stuck into immobilizing it and raising that rate. But the bottom line is the Fed is miles away from even the 0 now. They can go down to 25, then they can go down to 0, and then maybe they say, hey, loan this out. We'll go down to minus 25. You know, I mean, so we're really far away from that. But I absolutely agree with Michelle. There's a limit. I mean, you're not really going to go much more than -1, except for maybe Switzerland where you can't get the bank notes.
But you also didn't
but
think we could go
-1, I mean,
past
it's real.
0 historically, and now all of a sudden we're here. What's to stop it? Bill, what is it to stop the United States Federal Reserve from joining the negative interest rate party and doing, say, $5 trillion of some form of QE next year, because the entire global economy that's based on commodities has crashed?
I wish I had a perfect answer to that. I've stopped trying to guess what this Federal Reserve is going to do a long time ago, because it seems like they kind of play to what the markets want. And like, Yellen's testimony today was like that perfect, threading the needle between what the doves want and what the hawks want. And it's, to me, there's a limit. There's a limit on what monetary policy can do. And at the end of the day, if you look at what's going on today in fixed income, I mean, I really feel for investors in this market, because you have people who use these like traditional 60-40 mixes with 40% being in fixed income. They're like, well, I'm in that 40% because historically fixed income's always given me like a 3 to 5% return. It can't do that. In fact, it's very likely you might have negative returns in the future, depending on what happens. And people aren't ready for that.
So guys, are we underscoring just how busted the system is? People are being forced through central regulatory ideas into different types of asset classes that, again, is not in their best interest. Well, doesn't that form bubbles? Sorry.
Yeah,
I was just trying to duck that far, but you get my point.
Yeah.
Any lawyers in the house?
We really have to be careful. The reason that interest rates on governments are low is really a combination of events: the deflation, the really slow economic growth on GDP, and that risk aversion.
Yep.
I mean, and the central banks have kind of followed it lower, and then they had the 0 bound. And in a deflationary world, the real rate isn't really that low. It isn't low. Even if you have deflation, even if you have that 0 bound, the real rate is positive. So you can't do much. They've lost their margin, and they're desperately trying to get that 2% inflation to get some of it back, and they're not succeeding at the present time. And that's what's scaring a lot of people around the world. By the way, the Bank of Japan, and I was just actually in Tokyo for a week last week, what they meant by no limit is, they're far behind the ECB at the present time, and the Swiss National Bank. They said we can go to -0.3, -0.5. There is going to be a limit there. I mean, they're just trying to say there's a little bit more margin, but they've run out of it more than anyone else. I mean, the Fed actually has more steps to go here after having, raised it once on December than any of the other central banks. So in a way, we've got more margin to push a little bit more, and the Bank of Japan is sort of putting up its hands and saying, oh, my God, I don't know where else I can go.
And by the way, the reason why some of the income-oriented areas of the market have been hit so hard here is just what you mentioned before. It's because when rates were extremely low, even lower than they are right now, about a year or so ago in 2014, people were piling into high yield. They were piling into preferreds. They were piling into BDCs at 110% a book. And they shouldn't have been. And now they're paying the price, and now the overreaction to those liquidations are creating unbelievable opportunities in those parts of the market.
Are all three of you more concerned about deflation than inflation?
I am in an immediate term, yeah. I think
over
that's
the next
biggest
5
threat.
years?
That's a long term, but I would say certainly the next 1 or 2 years, I think that's the major threat. With fixed debt and deflating commodity prices and prices in general, making that burden of debt more and more and more.
It's
Bill, you
commodity,
agree?
it's commodity driven, it's not service driven, it's not
Yeah.
wage driven, because you're seeing
So-
spots there that are actually
I would
improving.
only say that how low is oil going to go? And if you stabilize the second derivative, we'll start to increase that deflationary
Well, that's
effect.
easy. Didn't you
Yeah.
read USA Today? It's zero. I mean, oil's going to zero. So.
Well, just a minute. Hey, you know, about that, you know, lesser grades of oil have almost gone to
Canadian
zero.
sands,
The
yeah.
Canadian sands have almost gone to zero. So, it's not that crazy in some sense.
I'm buying a tanker, I'm anchoring it off.
Let me throw a couple of questions from the crowd at you guys. Where do you forecast PEs once corporate buybacks scale down? Will corporate buybacks scale down if the Federal Reserve goes to negative interest rates and Apple can borrow money at negative 2%?
Okay, so let's think, you can think about this in the following way. So they're making, let's say, 6% on their capital. Right now, what they're doing is paying 2% in dividends, about 3% in buybacks, and they only need about 1% for capital investment. That's one reason CapEx is low. They don't need it. There's nothing for them to invest in. They don't need to expand their capital. There's no persuasive new technology out there that they need to invest in. You know, in the 90s, they were getting computers for everyone, the PC, then in the 2000s, the internet, and they had to put in billions of dollars. There's nothing. They don't.
The app
that's not-
revolution.
No, I'm saying that, so they only need, I only need 1% of it. Now, if they cut back on buybacks, what are they going to do with the money? They got to do something with that money. You either do CapEx, you do buybacks, or you pay dividends. If for a given earnings rate, if you cut back on the buybacks, you'll put it in dividends. You'll pay it as cash.
No chance they'll just put it on the
you'll
balance sheet?
buy other firms or do massive, you've got to do something with that money. I mean, we're giving 6% return here, which is consistent with an 18 PE ratio. I'm just saying, you got to get that money somewhere. Buybacks, CapEx, dividends.
And one would hope that they use the corporate cash to actually make reinvestments in their companies, right? I mean, that's part of what you're...
Well, you mean real CapEx in their companies rather than buybacks of their shares.
Right, exactly.
Correct.
Actually
But-
investing
but-
in technology.
Correct.
like you
Yeah,
were
but there
saying,
is no
innovation.
technology. What-
There's the smartphone and app revolution, the wearables revolution
That's
is
not
coming
what the
down the
corporations
pipe.
do.
Drone delivery services are coming
That's
down
not
the
of
pipe.
interest to the corporations. Ask them what are they going to invest. Ask them what they. There's nothing for me to invest in that I think has a positive marginal product. That's why interest rates are zero. I don't care if you give me the money at zero. There's nothing for me to invest in. In fact, they're happy to get their money back with no return.
I am on the entirely
I mean, look at the
opposite
oil
side.
industry. My God, if I could get my money back
Things
with
of
no positive
innovation, I
return,
wanna
I'm
invest in.
thrilled. I mean, that's why. There's nothing out there.
Each of you hit that question.
sounds
what
really
happens
bearish.
to PEs? What happens to PEs in the market as corporate buybacks, if corporate buybacks fade over the next 2 to 3 years? PE goes up or down?
What do they do with the money they earn? I have to ask that question.
Fair enough.
If they're going to pay it as dividends, nothing is going to happen. Now, if you're talking about corporate buybacks going down and the earnings going all the way
Collapsing.
down,
Yeah.
whoa, that's a
gonna
different
expand.
story. I mean, you got to tell me why what's happening to the money they earn.
And
You know,
how
it's
much
not
money
just
they're
if they
actually
put it
earning.
in dividends, it's fine. If they find great investments out there, Sonny, I see an increase in demand. Let me expand patent equipment. Fine. Then you're going to be all right. You just have to make it add up.
Here's another great question that I've actually been asking for the last few weeks. What conditions would need to exist whereby the Fed buys equities or maybe bonds, corporate bonds, as part of a QE program, much like Japan has for years?
Things would have to get as bad as Japan.
Yeah.
Are they not?
Not yet, thank
no.
God.
That would be so
No, our
disheartening.
economy's much more diversified.
Yeah. I mean, obviously, don't forget, in 1989, the Nikkei was 40,000.
Today,
I mean,
15s,
you're right. I
and
mean,
falling.
they've suffered a 25-year bear market of huge magnitudes. Of course, by the way, the price-earnings ratio of the Nikkei was 90 then, which was 3 times as much as any bubble we've had in our whole history. So, they deserve those returns at that level. They've been in a 25-year bear market. And by the way, a housing bear market of unbelievable problem. And I was there, people telling me, you know what, the same price for apartments in Tokyo as in 1984. I mean, go around here and same prices. there's nothing close to it. I mean, they've had unbelievable bear markets in virtually every asset except JGBs, the government bonds, as the interest rates were going
Great
down and
bull
down.
market.
Poor people.
So that's why they're buying, they're not only buying equities, they're going into REITs, they're trying to stimulate that market and try to stimulate the equity market.
Do poor people and savers benefit from deflationary cycles?
Oh, well,
To some extent, they do.
to some extent,
Yeah.
I mean,
Yeah.
you don't have, inflation erodes the real value of saving, and deflation increases it, but they're getting no return. So, the question is, do you want a 15% rate of interest with 15% inflation, or zero, this is what we have today, rate of interest with zero inflation?
It depends on how you
It's
classify
it's the same thing.
It depends on how you
It's
classify
exactly
poor
the same
middle class
thing.
too, right? I mean, if it's someone without savings, they're not going to care about the zero rate, but they'll benefit from lower gas prices, lower electricity prices, lower commuting costs, all that
As long
stuff.
as their wages stay.
Exactly, as long as their wages stay stable.
constant.
And wage inflation's been, reasonable here. It's been flatlining to slightly up. The last unemployment report actually was pretty
good.
good, a lot higher than I thought it would be.
And what about if you're on a government income? You're on welfare and you're making $2,000, $3,000 a month. No matter what happens, you're going to get that $2,000 or $3,000
Yeah,
a
no,
month,
it's-
right? They're not going to cut welfare benefits.
You're basically going to
therefore,
benefit in
my
that.
idea that the poor really do benefit.
Yeah, and I mean, but deflation in the long run ends up not being good for anyone though,
I
right?
think
Because it's
greater-
not good for the economy.
Greater GDP growth would be better for
Preferable.
everyone.
I'm going to take the other side of this coin too.
Yeah.
I much prefer a deflationary environment and a
I mean, we're
very
all
strong
enjoying it, don't get me
currency.
wrong, but I enjoy low gas. I enjoy pulling into the gas station, filling up my truck for 20 bucks. I mean, that feels a lot better than 60. But at the same time, I'm realizing that 20 bucks I just filled up my tank with, that's hurting a lot of local economies, that's hurting a lot of parts of the country. And that's,
But there's someone on the other side benefiting. With this question here from the crowd ties in exactly this. With the deflationary forces in play and long-term equities are a reflection of earnings and expected growth, what and why is the outlook for earnings over the next, say, 3 to 5 years?
Well, if you look at Standard & Poor's, it's up and it's crazy. I mean, it's way up. It's like up at 8% and 10% every year. And I begin to totally disbelieve these S&P forecasts going forward. They work on the next quarter and maybe the next year, and then after that, it's just like they pencil in these increases. I think we may get, if we get stability in oil, don't forget, I told you, we lost $15 of earnings probably this last year as a result of oil and the dollar. So the standard story is if we stabilize those, we're not going to get another ratchet down. But the problem is a lot of these things roll off slowly. So it might infect 2016 earnings. But if we eventually then get the oil back up to the 40s and 50s, that provides a really good push going upward. But I really think the 8-10% that I see and they just came out with 2017, 2016. Way too, yeah. I mean,
We're having this
way too high,
conversation
way
a
too
lot
high.
too. I mean, looking at companies and saying it's not a growth company. I think all of us need to reorient in a lower real return environment, lower global GDP environment. It's just lower, right?
Or maybe those companies need to invest in innovation and they'd get
They
back on
do,
that growth
they do.
track.
I see where you're coming out on all this.
I mean, what investment?
Geopolitically speaking, this question's all about the question of Saudi Arabia being able to impact oil. How does Russia, Iran, and the tensions between the Middle East and each of those countries play in?
Well, first of all, I mean, Russia is going all out. Its economy is in terrible shape, so it absolutely needs, it can't cooperate. It'll just need to go all out. And Iran, of course, with the new agreement, has somewhere, now, by the way, everyone's talking about 3 or 4 million barrels a day. That's way an overestimate because they used to sell it to China and others. Now China's asked to get it onto the main market. So the net increase in Iran may only be 1 million. I don't know. I've had different estimates of that as far as they're concerned, and they're going to need to build up their economy. So really, really there are not so many of those countries that have so much spare that they can really restrict. I mean, there's still, the Arabian countries still have a little bit of, they could.
Capacity,
Yeah, they probably could bring it down. Listen, it's just a rumor. I mean, if Saudi just says we're
Yep.
thinking,
5% cut.
we're considering a 5% cut, you got oil up $10 that day.
Yep, yep.
And then down $10 over the
Depending
next
on
month.
whether they go through it.
Yeah.
But the shorts will get real scared for a long time.
All right, guys, just a couple more minutes here. Could you each maybe give a 30-second or 1-minute insights into what your takeaway is here from the questions, from the discussion, what your outlook, whatever might be? Bill, you first.
Yeah, no, it's interesting because I've been classified as a bull here, and that's really the first time because I was really not one until levels in the areas I talked about got out to where they are because I'm very.
And I've read your stuff
Yeah.
from the last few years. I know.
I'm
were
very
cash.
finicky about that.
Yeah.
I'm all about margin of safety and levels and everything else. But when the markets start to get foolish, like they are in the case of high yield, and they start to overcompensate and overshoot, which they always do, that's when I get excited. That's when I become the kid in the candy store. That's when there's all kinds of interesting things to do that no one else wants to do. I mean, it's like I said in Institutional Investor a couple weeks ago. In areas of the market like high yield or BDCs or close ones, you got to kick everyone out of the club before it gets interesting. You got to be the only one sitting at that bar and make sure there's no one around you. You know what? I'm the loneliest guy on earth right now. Right? There's no one in the club. There's no one waiting in the line. There's no one within a mile of the club right now. So I'm in my comfort zone because I don't want people interested in what I'm adding to the portfolio right now because that tells me that it might be overvalued or might be too overfollowed and not, again, the last time I made a trade that I felt, that I made without almost feeling like I needed to throw up on my shoes was a long time ago, and I've been nauseous a lot lately. So it's been interesting. So, like I said, being bullish or bearish, to me is a measure of where that margin of safety is, and the more the math works for me, the more the break-even math works for me, the more bullish I get. And this stuff is absolutely blown out in some cases to 08 type levels in certain subsegments of the market. And that's why I am where I am right now.
Michelle?
I would say the one area we didn't touch on as much as emerging markets, and we do have a lot of standalone strategies in emerging markets and also as part of our global strategies. I would say we're more cautious. There are a lot of cross currents that do concern us fundamentally. But the valuations there are below anything we've seen in a long time. So when we do think about the next 5 to 8 years, there are many places in the world that we do want to make sure we maintain exposure to. We have 10% exposure in our global portfolios to emerging markets, but I wouldn't be surprised if this continues, that we will start to get as excited as Bill is about high yield. But it's close. I mean, there's a limit to how negative you can get because China is opaque and it's slowing. It still is growing and we still have positive things going on.
I'd just say there is no limit to how negative I can get on non-U.S. equities. I stick only with the United States with the exception of Sony.
You do have to break this choil narrative, though. So
Say
we
that
talk about
again?
choil. It's like every day it's choil, China and oil. You got to break this
Choil,
narrative.
yeah.
I
No,
mean,
I'm
it's just
okay
it's
with
so
just
old
owning
and getting so
fame.
worn out. I mean, it's just crazy.
Dr.
Yeah,
Siegel.
well, everything Bill said about the high yield, you could say about the emotions of investors
Sure,
going in and out. Can
absolutely.
be said about the equity markets.
Yep.
We always know bearishness is very high. Investors' intelligence bear ratio is the highest since Lehman. We've seen a lot of blood in the high energy sector, in the energy sector, in the high yield connected with energy, and of course it will always infect across. I do agree with you. I think there's probably some good values there. Emotion always brings markets to overshoots in greater extremes than the fundamentals, and they always come back.
They do, and they sometimes overshoot to the upside.
Oh,
Yes,
absolutely.
absolutely.
We saw that in the
2014, you said.
NASDAQ 2000.
Yeah, absolutely. Or like you said, the Nikkei at 40,000.
Yeah.
Be sure to check out tradingwithcody.com. I do actually pick stocks, and I've owned Apple and Google and Facebook long before they were what they are today. And also check out Scutify, the apps that that my company runs. They are innovative, and they are going to help change this financial industry. I'd like to thank each of our panelists here, Michelle Seitz, Bill Eigen, and Dr. Jeremy Siegel. I'm Cody Willard. Anything else that I need to say here before I wrap this up? I'm going to bring it back to Julie.
Thank you. Good.
Hey, good seeing you.
Thank you.
Thank you so much for being here tonight.
Thank you. Thank you.
Tokens of appreciation for you. And just thank you all so very much for sharing your expertise and your presence
I didn't break
with
the
us.
tokens when I fell off the stage.
No.
Hurt my
Made
shin,
of strong
but I think
stuff.
the tokens
Oh,
are okay.
I thought they'd all be cracked in honor of these markets.
Then it
Thank
really
you, everyone.
becomes-
Have a wonderful evening.
Oh, sure.
Oh, sure. Yep.
Get this
Thanks,
back
you.
on.
I'm gonna
Good.
Oh, you're gonna D-Mike?
Yeah, we're gonna get there
Axel.
together.
I'm not D. Mike. I want him hearing what I'm saying.